Hi, this is Jack from Alpha Charts 365 with a State of the Market video. Today is January 25th, 2020. Before we get started, this is not a recommendation to buy, hold, or sell any stock or security. This is for informational purposes only, and I may hold positions in some of the stocks mentioned. You should know your time frame and your risk tolerance. All right, so today I'm going to lay out both bullish charts and bearish charts and then give a little wrap up on what I think is going on at the end. All right, so first we're going to go with the bullish charts, okay? And we're actually going to start with the indexes because if you look at the indexes, here's the SPX. It is in an uptrend and we have all the major moving averages moving up. We have this trend line, which hasn't even been tested yet. So for now, the indexes, to me, SPX, is in just an uptrend. Again, we did see this nasty day on Friday on reasonable volume with like a bearish engulfing type of pattern here, but that in and of itself is secondary, I think, to the uptrend behind it. Look, moving on to the Qs, very similar to SPX. Uptrend is even further away from this moving average here, and all the moving averages are up. A little bit more of a distribution day on the Qs, but again, the uptrend is still intact. IWM, now this one looks a little bit weaker, right? Because we already broke the 23-day EMA. We've had some weakness here, so you know it's but still the longer term trends are higher. And this could potentially be just a retest of its breakout at some level. Whether it's here. It doesn't have to be end of the world stuff. So again, the trend is higher here, even though we're seeing a little bit more weakness in the small caps. Dow Jones Composite Average. We have the beautiful breakout uptrend. And this is just sideways consolidation, is the way I read it. Again, it was on a little bit higher volume here, but it is just sideways consolidation. So as of right now, I think that's how we treat it, consolidating gains. Again, more bullish charts, right? So we're doing all the bullish ones at the same time. SMH, if semiconductors are going higher, then it's going to be, pretty good outcomes for the stock market, in my opinion. And we have slightly higher volume on this down day on Friday. But all the trends are higher, all the moving averages are higher on the short, medium, and long term. Put call ratio. We'll change this to a line chart, make it easy to read. All right, so, last few weeks we talked about how this was getting frothy, right? And that we need some kind of shakeout or pullback to get rid of the excessive bullishness in the market. Well, that's kind of what we got on Friday, right? This is what we said we wanted to see. It did what we wanted it to do, and so whether it even pulls back a little bit more and gets into this range, I mean that's how bull markets kind of run. Every time it gets into this overbought condition, it pulls back, right? Sometimes more steeply than others, but it pulls back, and so I think this is a bullish situation that the put call ratio is now going towards 1. Moving on. Value line geometric index. Value line geometric index, if I type the whole thing out in there, is, what did we say? We said it had moved pretty quickly from support to resistance. It tried to break out. I was talking about how a nice little pullback and then the breakout would be the most bullish scenario. So it moved sideways, broke out. It's coming back to retest it. Even if it dips below to the 65-day EMA and then breaks out, I would still be in the bullish camp as long as the 65-day EMA holds. If we break through that, you get the 150 down here, and then below that, and then I think you're back in this range firmly, and chop is likely and potential breakdown. But right now, it's just a retest of the breakout, so it's still in the bullish class. The next really bullish chart to me is home builders. I mean, look at this on the weekly basis. On the week, home builders are just breaking out of their 2006 highs. It's a 14-year base, and we're just breaking out now. All the trends are up on the weekly. You look on the daily, all the trends are up. We're breaking out. Yes, we may come back and retest this area, but as long as this green area holds, home builders, they're a huge part of our economy and employment. And so it's, again, if people are employed, it's going to be hard for the stock market to go down. All right, so those were my risk on everything looks fine, don't panic charts. Now here are some other charts. These are my more bearish charts that I'm seeing. And again, we're going to go back to the weekly on this one. Okay, we have financials, XLF, rolling over at this very important level, right? We try to break out just a little bit right there. They're starting to roll over. Going back to a daily chart, you see that the short-term moving averages have already been violated pretty drastically. And and next up will be this $30 range, right? So we'll see what happens when it gets there. Another thing that I'm watching that could be bearish is lumber. Lumber is starting to roll over, right? We already broke the 23-day EMA. The 65 is next. It's close by. Again, if the lumber rolls over, that usually is a good predictive indicator for the next 3 to 6 months for the stock market. So this is definitely something to watch. Bonds. Okay, so the 10-year yield. So the way I see this, again, let me just go ahead and sharpen this up a little bit. And let's take a look here. We have this kind of bearish flag. We're breaking down from the flag right here. I think this 1.45 level is going to be important, right? Somewhere around here. But really the targets, in my opinion, are going to be more like this 1.27 and potentially even 1.06 and 0.85, right? So if things are going to get really bearish and this is the top, we can see bonds start to move down to all-time lows. If this is just a run-of-the-mill pullback to shake out excessive bullishness, well then you know what? 1.4, even 1.36-ish will probably hold, and we bounce back up and things start going in the right direction. But if bonds are breaking down, yields are breaking down, people are going to safety, obviously. And as you would expect, bond yields are breaking down. What are utilities doing? Utilities are ripping. They're ripping higher all-time highs. So people are looking for yield, and it's a flight to safety potentially. So that's a bearish chart in my opinion with XLU ripping. And actually, I haven't even looked at this chart yet, but let's look at the relative basis. And so this was an important area, and we bounced off of it, and now we're going higher. And so with utilities outperforming right here just recently, that is something to watch. All right, next up will be let's look at the gold versus SPX. And it helps if I type right again. Gold versus SPX. And what am I seeing here? I see a big bottom, right? Nice big bottom that's happening. Just go and sharpen this up here. So we have the downtrend starting to make this bottom, and gold looks like it may want to start to outperform the S&P. Again, that would be more of a flight to safety type of idea. Let's look at copper miners versus gold miners, right? Copper miners versus gold miners. To me, this looks exactly like the 10-year yield, right? I mean, almost exactly like the 10-year yield. So if copper miners are breaking down relative to gold miners, right? Almost the exact same chart. It's unbelievable, really. Look at that. TNX. Boom. Same chart. Really crazy, huh? But if copper miners are breaking down compared to gold miners, what can we expect? We would expect more of a flight to safety and a risk-off trade. Let's look at gold on an absolute level. Gold on an absolute level is breaking out. I actually bought some miners on Friday because of this chart. I mean, this looks unbelievable. I think gold is going to be going higher at this point. No reason not to think that with this amazing looking chart. And yeah, I mean, if gold is going higher, again, it's a flight to safety. You know, another place that we want to look at is real estate, right? If you look at real estate, breaking out to all-time highs, right? This is the VNQ. All-time highs. Again, people looking for yield, flight to safety. Let's look at high yield bonds, right? High yield bonds. High yield bonds got rejected at overhead supply and now are moving lower, right? They broke through one moving average, about to test another one. Again, if people are getting out of high yield bonds, it's a risk off indicator, in my opinion. Moving on, let's look at some world indexes. China with the whole coronavirus thing, which may or may not be the cause of this most recent volatility. Yeah, China broke out, and this looks like a false breakout right here, right? So if China does a false breakout from this beautiful looking double bottom, right? Last week I was singing the praises of China. This week it's a false breakout. And so we need to watch this. And again, any further weakness here, and this could get ugly really fast. Hong Kong just declared a citywide emergency. And so what do you see in the charts? I mean, I see breaking down below all moving averages, and the shorter term and medium term, the short one turning down for sure. The medium long term ones are flattening out now. Further weakness, and Hong Kong could be in big trouble. And you see, this is a pretty significant area that it's at right now to begin with. And the last one I'm going to look at is European banks. Again, a double bottom look. It got rejected here, and it's breaking down below the short term, rolling over, medium term. It's right at it, basically. That's flattening. European banks may start to break down, okay? This was looking really good. I was really digging this pattern and had some equities in this area. I've now sold those because we are breaking down. All right, so the last one stuff we're going to look at is going to be discretionaries versus staples. All right, so long-term trend on this one from 2009 is right here. And we have not broken this yet, right? We have not broken this. So right now, if we bounce off of here and go higher, I think that'd be a very bullish situation. If we break this trend line, it'd be very bearish. Now, a lot of people say, but hey, you have to know what you own, right? And that's a really valid thing. So XOY, Amazon, 23% weighting, Home Depot, 10%. Then you have McDonald's, Nike, and so on, okay? So as you can see, it's dominated 33% by these two stocks. So how these two stocks go, they're going to bully that index around. And staples, Procter & Gamble, 16%. Coke, 11%. Pepsi, 10%. Right there, you're looking at, was that 37%, right? Again, these three will bully this index around. You can even throw Walmart in there, and that's really big. It's about 45% or so. So, right, so those stocks will be dominating. So, what do? Let's look at equal weight. Okay, equal weight, and what do we have here? Well, a very similar looking chart, right? We have this uptrend line here, and we can just adjust this, maybe even want to do this or that, whatever. But this may be a breakdown right here, right? This is something I'm watching. Continued weakness here, and it says that on a relative basis, the equal weight staples are outperforming discretionaries, or discretionaries are underperforming staples, however you want to put it. So I think that this is a chart, as this breaks down, if it breaks down, is really, really significant. So what do I think? To close this up, I think we're in an uptrend, right? I think in the end, price pays, and this is the uptrend, and it's strong, and they're going to be pullbacks and shakeouts along the way. But I don't believe that as of today, that is anything more than that. We said there was excessive bullishness. This is how the market works. It shakes it out, and then it continues higher. If we start breaking moving average and they start to roll over, that will change my mind. I hope you guys have a great week. Good luck this week, and know your time frame and your risk out there.